So we're going to be working on income allocation for multiple years, year 1 and year 2. And so here we have a partnership of CWN, and they have initial investments which will act as the beginning balance for year 1. We can go ahead and put those in here. And then add that up to get the total. All right, then they tell us for the division of income, they've agreed to 3 separate ways of allocating income. The first is everybody gets 10% on the beginning capital. Then W gets a $10,000 salary allowance, and after that they share the remainder in this 20-40-40. And if after the priority allocations of interest and salary allowance that's more than what income was, that remainder might be negative, because the sum of those 3 has to be the profit or income of the partnership for that year. So let's get started here. Let's do 10% on beginning balances. And then W gets 10,000. So we've allocated 55,000. So if income is greater than 55, we would do the remainder as the difference. So profit is what in year 1? 150,000 minus what's already been allocated gives us the remainder that is to be allocated based on this 20-40-40. So C would get the remainder times the 20%. W would get the remainder times their share of income. And so that all these cells together equal the 150 that has been allocated based on the partnership agreement rules which they gave us. Each partner withdrew 1,000 every month during both years. Okay, so that would be 12,000 a month for each of them. Okay, anything else? That looks like that's it. So then we would do the math and add up the partnership capital balances at the end of year 1, which would be the beginning of year 2. And now we go ahead and start on the same activity. What's different is the profit. They still have the 12,000 withdrawals as they did in year 1. Now the 10% would be the beginning of the year, which is now a different number than it was last year. All right, and W gets their 10,000. And so now we've allocated 66,400, and we need the sum of all in the box to be second year's profit, which is 180. Okay, so 180 minus what's already been allocated gives us the remainder that must be allocated, and that will be based on their share, what was put in the partnership agreement as to what percents they each would get, and we will honor the partnership agreement. And then we can do the math, the beginning plus all that activity for the year gives us the ending in each of the partners' accounts. Now, this would be a good time for you to stop and see if you can do Part B now. And then you can restart and see whether or not your Part B matches my Part B. Okay, so in Part B, we have the same initial investments. We have the same withdrawals. So we would have the same 10%, but what's different, of course, is that we will be spreading the remainder a little bit differently because the total profit's different. So we're still going to give 10,000 to W, and we want the sum of everything in this box to be the new profit. And so net income is 50,000 in year 1, and we've already spread 55. Well, total is only 50. So if we subtract what's already been allocated, we'll have negative 5,000. So you would assign their share of the negative. And then add those all up to get the end of year 1, which is the same as the beginning of year 2. And so year 2, we still have the same withdrawals. Now the 10% is on a different amount because the income allocated differently because the profit was different. We're still giving $10,000 to W per the partnership agreement. And now what is in the income allocation lines, the 3 that enter this box must total the profit in year 2, which is now $30,000. Okay, so 30,000 minus what's already been allocated, which is way more than 30,000, so you know that's going to be a negative number. And then they share in that based on that percent that's in the partnership agreement that they agreed to at the time that they created the partnership. And so then you add it up and you can get the new partner capital. So that wraps that up.